Hello, everyone. My name is Robin Dolezal. Today is Wednesday, January 19th. With me, as always, is Dan Nentel and Alex Pars. Together, we are with Ironwood Financial. Good afternoon, gentlemen.
How's it going?
Hi there.
For many of you, this is the first time you're seeing us, so let me say Happy New Year. I hope you guys rang in the new year happy and healthy. How are you gentlemen doing? How's your breaks?
Good. Got to see some snow with the kids.
Good. I learned that I am a subpar skier. I thought I was good, and my wife got me a fun little toy, and it told me that I am not as good as I thought. So that was fun. And Dano, I know I'm going to be the first one to wish you an early birthday. I know it's not for a week or two, but happy early birthday.
Well, it's actually in a couple of days, and then right back at you since yours was a couple of days ago.
Yeah, yesterday. I guess I thought yours was a little longer than mine after, but that's okay. We get to share that.
Yeah.
Well, I hope you have a good time. Well, guys, I think this is the first one of the year. Obviously the market was happy last year, but Dano, I want to get your thoughts on what's going on in the market currently.
Yeah, I mean, you could really peg last year based on what was going on. Two main things: what was going on with COVID and what was going on with the Fed. And the same thing's true for this year. To be honest with you, we're seeing right now the Fed announced that starting in March they were going to start to raise interest rates, and history tells us that's not usually good for the stock market in the short run. And the reason for that is when you raise interest rates, that's usually because we're seeing high inflation. So inflation tends to hurt a lot of the people that aren't invested in the stock market. And as they raise interest rates, realize that affects all interest rates. That means that CDs are going to do better, so that people may be enticed to go to a CD right now. I think I heard, Alex, you mentioned somebody about a 1-year CD or a 2-year CD that was paying 1%.
0.95.
0.95. Now realize though, put that in perspective. Last year they pegged inflation at 6.8%. So your CD getting over 2 years, 1%, so 0.5% per year, taxable. And then this year, at least, inflation was 6.8. So not super attractive yet. But the problem is Wall Street thinks forward thinking, and they think to themselves, as interest rates go up, CDs and safe investments will start to go up, which means there'll be an enticement or some attraction to move your money out of the market. And whenever there's more sellers than there are buyers, like we saw today, especially at the end of the market, end of the day, more sellers than buyers means the market trends down. The other part about it is if interest rates go up, that also means that mortgage rates go up, car loans go up. And the bigger issue right now, especially you're seeing in the tech world, is the cost of borrowing goes up. And right now they're saying you're seeing the tech industry down about, I think it's about 9% year to date. If I'm looking at this graph correctly, I don't know if I updated it. I think it was down 7.5 and it was down a little less than 1.5 today. So that looks about right. But 9.1 is what I'm seeing. And a lot of that is because people are just worried that the big tech companies that take loans to do their infrastructure and, trying to think of all their new technology and intellectual property, it's going to cost them more money for that cost of borrowing, and then it all comes down to, which is weird because last year this didn't come into play, but people are worried that they're going to miss earnings. And so remember, last year and probably the year before, the stock market there was so much stimulus money, child tax credit, PPP loans, et cetera, that people had money, and the common sense theory kind of left the world. And that was buy anything, it's going to work. We saw Bitcoin, we saw gold do a little bit, but every stock went up. Reality is that money's starting to run out, and we're starting to figure out that maybe we need to get back to fundamentals, which is earnings. And if you look at a company that when the cost of money goes up, their earnings goes down, which means the price is too high and then the price should come down. And as I'm looking right now, year to date, gold is down about exactly 1%. If I'm looking again, these could be off 0.5% or so, but I just updated it. The S&P is down about 9 or 8.3%. Is this, let's see, I think that was the NASDAQ. I guess that's mid caps are down about 9%. We're looking at Bitcoin down about 13%. So every asset class has been beat up, and it's all because of what the Fed is doing. Of course, Omicron is part of it because we're seeing companies like, for example, my daughter, when we were flying her back to college, we had to buy 4 different airline flights because every flight kept getting canceled. Right.
Wow.
And why were they getting canceled? Well, they didn't have enough staff, didn't have enough grounds. One was they didn't have grounds control. There was to actually bring the plane in and out of the dock. So that means they lost revenue, which is going to hurt earnings. And so when people are understaffed, there's a restaurant near my house that closed for a week because they didn't have any staff. So obviously they're not making the revenue. So right now people are worried about our company is going to be profitable. And the part that's somewhat optimistic for me is maybe we'll get back to normal. Maybe that weird phenomenon, and I heard this in a meeting with Alex not too long ago, that weird phenomenon that people actually want to buy companies because they make a profit. And I think that is something that's not here yet. Realize they're talking about raising the interest rates in March, which means the market will probably get more scared or more volatile. So I think we're in for a wild ride. I don't think what we're seeing the last 3 days is really an indication of what we're going to see in 2022. I think there's money on the sidelines. We'll jump back in. But anyway, it's an interesting time that I think we're getting more closer to normal.
Yeah. Well, so Alex, before I ask you your thoughts on this year, let's jump back to last year. Any thoughts on last year? Any surprises? Were you happy with it?
I think really just to reiterate what Dan was saying, which is the stuff like the meme stocks, like this is cool, so it goes up. I feel like that persisted quite a bit last year because people had money to throw at it. And now that free money is stopped. So those people, not only were they making money on these wild gambles, they had more money to throw into it next week. And so every week they throw more money into these wild gambles and they'd keep going up and suddenly they felt rich. And now the free money stopped. So even if those things go up a little bit, suddenly they may have gotten used to a higher standard of living and now they may have to sell some of that stuff. And so what we've seen so far this year, as Dan was mentioning, a lot of those companies that don't have justifiable stock prices have fallen hard. And so I think that this year is going to, like Dan said, get back to much more normal, much more fundamentals. Again, we're looking towards, value stocks at this point. I know we said that some last year, and there was kind of a neck and neck race at times throughout the year between value and tech. So far this year, value is way outperforming tech. I think a little bit outperformed last year, but the PE ratios are still way out of line, especially if you look at rising interest rates. So we're much more looking at conservative stocks that have profits, as Dan said, and stocks that actually have a business model. That's another fun thing to look for. Wait,
Alex, I have a question for you. And, we used to have this thing called the Christmas or holiday hangover.
Mhm.
Concept being people overspent. Studies have shown people have overspent. And normally they have to pay off their credit cards because they overspent on the holiday season of purchasing. And it's been a phenomenon that's gone on for many years where, again, the hangover after the first of the year, where people are liquidating assets to pay things off. And last year we had record amounts of people making money on foolish things. Would you say that, by the way, I made a mistake. Bitcoin was actually up today, and it's actually tied with the NASDAQ year to date, with both being down about 11 is what I've seen. Again, could be off a little bit, Yahoo Finance. But do you think people are just selling, paying off credit cards, and this is a short-term hangover?
I don't think this has to do with Christmas spending so much as it has to do with the free money drying up. Because again, everyone was getting, a check or unemployment or the child credits, and all that money was coming in, and then that money all just stopped. And people could coast for a little while, and then maybe their credit cards have built up and they don't have that money to pay off, or they don't have that money to spend. But I think it's more just plain discretionary money. It's found money that was, I didn't have this before, what do I do with it? And if you remember during the pandemic or the worst of the pandemic, you couldn't do anything, so they were putting in the stock market or crypto market or whatever. And now they've got to get jobs, and they don't have time to play with that, and they don't have found money. They've got money maybe that they've earned that feels more real. It's less likely something you want to risk on a wild hair. So that's the feeling I'm getting just from watching the trending tickers, so far this year, is a lot of the stuff that was like, wow, this is really going up for no reason, is going down for, I would say, a reason. So again, that is not to say that the markets is necessarily going to have a down year or should be down. It's more a question of what sectors are going up and what sectors are going down. And those sectors that were overbought, I think now have an opportunity to sell, and we'll be looking for opportunities to buy into those as they get cheaper. And something, as you mentioned, interest rates are still a big deal. Just because the Fed is raising interest rates, stopping QE, all that stuff does not mean that we're going back to, back in the day when we got 8% bonds, right? That's not going to happen anytime soon. Right now, as you said, 2-year CD at 1%, that's not attractive enough to get money to pull out of the market. So that's just a bellwether, if you will, as opposed to boy, that's a true competitor. Nobody's saying, oh, I'd rather get 1% than have money in the stock market. So what we need to do is watch that number, watch the 10-year treasury. As that number creeps towards something that's relevant, which is I'd be happy earning a guaranteed 5, well, then that's a true competitor to the stock market. But if inflation stays where it is, even 5 is probably not going to cut it. So we need to see 7, 8% if inflation stays where it is in order to have a real competitor to the stock market. So the TINA thing, there is no alternative, is still in force. It's not quite as compelling as it was. There are some arguments that it could change in the future, but there is no other game in town still. I mean, you're not going to keep up with inflation with anything but risk assets. And that's not likely to change in the next few months. So as you said, I think we're going to see, if we see a big downturn, we're going to jump on it and we're going to do a little bit of buying and hopefully see a V recovery, because fundamentally the economy is wonderful. And I think they're still trying to get another stimulus package passed. So if they do that, we should see this all come roaring back, maybe in different areas that have been harder hit, areas with better PE ratios, higher profits, as opposed to pure speculative plays of someday they might have a good product.
Okay, last question. So what about the Fed? Are you surprised at all what they're doing? Do you think they're acting quickly? What are your thoughts?
I think they're still being somewhat cautious if you think about it. I mean, they're still adding QE to the market.
Right.
And inflation was 6 and change, right? So that's pretty aggressive if you think about it. And then once they get to the point where they've stopped the QE, that doesn't mean they're unwinding. So that's really the big question, is when do they start to unwind? Because they've built their balance sheet up to something like $9 trillion. And for them to maintain that balance sheet means that they're active participants in the bond market and they can manipulate rates. So until they start unwinding to a significant degree, they still hold rates where they want them. And with the numbers they're throwing out on the TV in terms of COVID cases, I would be surprised to see the Fed get really aggressive, at combating inflation, as opposed to trying to make sure the economy stays afloat.
Well, I appreciate that. Go ahead, Dan.
I was more of an interesting, fun question. It's so easy when you're on the internet to see an interesting article, and then before you know it, you're finding out that the world is going to end, or that the Dow is going to 70,000 this year. I mean, this past Saturday, I was the boys had a sleepover. I'm sitting there kind of goofing around, waiting for them to get up, and I started going down a rabbit hole of travesties about catastrophe, but bear market of all bear markets. And I started reading about it, and I realized most of these people that were saying that the market was going to collapse were either selling crypto or selling gold. Is there any merit, in your opinion, of having a crypto or a gold? I mean, crypto rate's down Bitcoin's down 50% from its high. I'm sorry, 50% from its high. It's down 20,000 points or dollars. And then gold's still down 15% from its high in 2009. It doesn't seem like they're almost being sold more than they're needed in this current economy. Am I missing something?
I think, well, those are two different animals. Crypto is a newfangled thing, if you will. And it's something that people were saying it's going to be an inflation hedge. And last year it was a good asset to hold. This year it's yet to be seen. But again, the people who were buying crypto were the same people who were buying meme stocks, right? They were doing it with extra free money. And so now, a lot of them made a lot of money on it. And honestly, they've been spending it on silly stuff, right? Like NFTs, right? When if you don't have extra money lying around, you're not buying NFTs.
No.
Right. So now I think people are probably selling some of that assets, so those assets to support their lifestyle. And that's, and unless there's some sort of compelling argument to say they should go up, I think we're going to see a period of doldrums for them. That being said, in the long run, I think they're probably here to stay because there's so much money in them. And they are kind of a clever little Ponzi scheme. But, you know, I wouldn't say that they're necessarily an inflation hedge. Gold, as far as I'm concerned, is not an inflation hedge. It's got now the added competition from crypto. And I mean, you look at it from 1980 to today, and you would have lost like half your money to inflation. So that's a pretty long period of time for, you know, to say that that's an inflation hedge when in fact it's not. And I think it's lost some of its luster as a flight to safety as well. I mean,
I would agree. Thank you.
so.
Well, thank you, gentlemen. We'll obviously continue this conversation as the year goes on. If you folks are watching and you had questions that we did not address today, please don't hesitate to reach out and we will either get back to you immediately and answer those questions or address that at our next video. If you have questions, you are not a client, you'd like to reach us, you can find us at ironwoodfinancial.com. You can find us on Facebook, or you can call us toll free 888-271-4646. Gentlemen, I hope you enjoy the rest of your afternoon, and I will see you soon.
Take care.
Yep, we'll be back in a couple weeks, if not sooner.
Yep.